a home in Kansas City seems to be getting more and more difficult every single week. And for the most part, it all comes down to mortgage rates. And over the past couple of weeks, of course, mortgage rates have started exploding again. So this video, we're going to break down exactly where they stand. Number two, we're going to break down what you can expect over the next couple of months. And then finally, we got to end with some good news here. We're going to end with when you can expect the storm clouds to kind of fade, mortgage rates to return to a normal, reasonable level. And then if you just bought a home, when you can go ahead and refinance it. Part number one, why housing affordability in Kansas City has gotten worse and where mortgage rates stand today. So take a look at this chart. Earlier this week, they were above 7%, which is just crazy. You can see right now they're sitting at 6.985%. This is definitely on the high side over the past 12 months. And to put this into perspective for you, here's a chart that'll show exactly what has happened since April of this year. You can see a lot of pinballing up and down, but generally we've got a pretty steady trend upwards, which is not ideal because over this timeline, we've had a lot of people come out of the woodwork and say, hey, mortgage rates are probably going to fall over the next year. But it seems like all of those predictions just keep getting pushed back and farther back, which is not ideal if you're currently in the market for a home or anticipate looking for one in the next year or so. So it leads us to part number two. What's behind all of this? What can we expect over the next couple of months? So basically where we stand right now is inflation is like the reason why we're increasing interest rates and why mortgage rates are so high and why buying a house is really expensive right now. So inflation actually subsided last month and it led the Federal Reserve, after increasing interest rates basically every single month for the 12 months prior, to basically say, you know what, it's looking good. We're going to hold off, but we might be back in July. Well, they're coming back in July. According to this article from Reuters, it says the Federal Reserve will likely raise its benchmark interest rate later this month to a 5.25, 5.5%. And it also goes on to say that traders now see about a 20% chance of a rate hike in September and a 40% chance of one by November, after what is nearly universally expected to be a quarter-point increase in the late July meeting. So take a look at this chart. You can see that, well, the federal funds rate, interest rates, are not perfectly correlated with mortgage rates. They're kind of acting in lockstep right now. Every time we increase the federal funds rate, you can kind of see mortgage rates go up. So what I think is happening is when the government does go ahead and increases the federal funds rate, like everybody predicts, hopefully mortgage rates will hold steady because they've already factored that into the risk calculus. Now, the reason that initial quote we read actually matters is while traders are not, they don't have a crystal ball or anything, their entire career does depend on making very accurate predictions, many of which are heavily influenced by mortgage rates. So the fact that they're pricing in some sort of rate hike in September or even November, that's not good news, especially because pretty much every prediction about where mortgage rates are going to be headed later this year basically comes down to this chart. You can see Fannie Mae, the Mortgage Bankers Association, National Association of Realtors, all this data basically all came out before everything we've talked about so far in this video. Now, I know this is all bad news so far, but I am determined to end on a good note. And we're going to do that exactly. But if you are in the market to buy a home over the next year or so, a lot of craziness happening, a lot of volatility, and the market's really competitive. So one way that you can gain an upper hand is just by staying in the know, staying updated, knowing exactly what's happening with mortgage rates, why it's the controlling factor, why it's influencing housing affordability by so much. And I invite you to subscribe to this channel because we do these updates every single week. If you're updated in this really competitive market, it substantially increases your chances of getting a good deal and striking when the iron's hot. Now, before we head on to number three, I've got to give you a little bit of context, right? We've talked about the federal funds rate or interest rates. We've also talked about mortgage rates. And the one thing that'll come into play on part number three is the big distinction between the two, which is that interest rates are much more short-term. Mortgage rates, however, are based on longer-term calculations. Now, part number three, the good news, when we can finally expect mortgage rates to normalize, and when, if you just bought a home, when you can expect to probably refinance or at least be in that territory. So according to this article from fortune.com, they cite a report from Morningstar, which is a leading financial analysis firm. Long story short, that distinction between the short-term federal funds rate or interest rates and long-term mortgage rates definitely comes into play. And the reason that this article is more accurate than some of the predictions that we'll see that come out pretty much every single single month about mortgage rates is those are all based on short-term trends of the economy. This report is looking at long-term trends that span decades. So it all starts with Morningstar expecting mortgage rates to remain low, and they're citing factors like aging population, slowed productivity growth that put downward pressure on long-term rates like mortgage rates. They also go on to say that regardless of what happens in the next few years, we expect rates to ultimately settle back down to the low levels that prevailed before the pandemic. So what did those look like? Well, take a look at this chart. Basically, before the pandemic, we were looking anywhere between 3.5%, like right up against the pandemic, that like that gray shaded territory you see right there, and pretty much around 5%, which is pretty good territory to be in, especially when compared to the near 7% that we saw just this Monday. Like that's hundreds of thousands of dollars of interest payments over a 30-year time frame, which is just crazy. Morningstar goes on to say factors such as aging demographics, slowing productivity growth, and increasing inequality have all acted to push down real interest rates for decades, and those forces haven't gone away. Now, here's where all of this kind of comes together. If you look at the 1900s when interest rates and the mortgage rates to buy a home were like 14, 15%, the reason those were affordable then and not now is because wages have been stagnant basically since that time. Wages have not kept pace with the price and the value of real estate. So if the one thing has to come down in order to prevent the entire real estate market from crashing, and that thing traditionally has been mortgage rates, right? The one lever that impacts housing affordability the most is mortgage rates. If we were to try and implement 14% mortgage rates today, when wages are not comparable to when they were back then, and home prices aren't comparable to where they were back then, it would just be a total mess. And likely they'd just topple the housing market and it would bring down the rest of the economy with it. So the one thing that has to budge, according to this report, is mortgage rates have to come down over the long term in order to make housing more affordable. So basically, the more definitive answer here is that if Morningstar is right in their calculations, and keep in mind anything can happen, but they are citing longer term trends that matter much more than these short term little hiccups that matter for interest rates. Take a look at this chart. It basically shows the complete breakdown. They say by about 2024, we should see rates about 4.75%. I bet a lot of people will just go ahead and refinance right then and there. And then by 2025, we'll see about 4% mortgage rates, which is great. And then they anticipate going back up just slightly, a quarter point in 2026. So this is ultimately good news. What you can take away from this is probably within the next 2 years, you'll find that window. If you are waiting to buy a home until that happens, give it a couple years, maybe just a year, and you're in target range. If you're waiting to refinance because you just bought a home at like 6% mortgage rates, again, 2 years, and that might just be it. And you might have that lower home price that you locked in yesterday, but also get tomorrow's lower mortgage rate. Now, it's probably unlikely that we should hold out hope for anything below 4% unless something catastrophic like a COVID happens and we need to inject a bunch of cash and stimulus into the economy and get people spending money. Seems like that's probably not going to happen with the way that inflation's acting right now. But again, who knows? Maybe that's not even a concern, but it looks like the target range right now is within the next 2 years around 4%, which is pretty good news if it all pans out. Now, I know this stuff is super complicated. It definitely helps to have somebody right there with you, a second set of eyes when you're navigating all of this stuff. If you'd like to have a conversation about all of this, how it impacts you, if you are in the market to buy or sell a home, I would absolutely love to clear some time for you and make sure we're able to answer any questions you have. So if you think we'd be a good fit, all my contact info is down in the description. It can be a phone call, text message, email. We can set up a time to talk and make sure you are set up for success. If you enjoyed the video, if you found it helpful, if you're looking forward to mortgage rates decreasing sometime in the next couple of years, hit that like button for me, subscribe for weekly updates. I'll see you on the next one.